So the last one is under the profitability ratios only. And the profitability ratios is this is general profitability ratio, and now this is overall profitability ratios. In this one we have a good number of formulas, but I have cut out to 6 only. So in this one, the first written. Now every time here overall profitability, when I am going to talk about it, remember we call this one a written. This is a one word you just remember. In every case we will have a written. Written means in that particular formula compulsory we will have a profit, a net profit, either a before or after tax. So first one he is talking return on shareholders fund. So when he is asking a return on shareholders fund, we will be taking a net profit after tax by shareholders fund. Already in the previous second category, shareholders fund means I have told you equity plus preference plus reserves and surplus, together we call it as shareholders fund. So here when we are giving to the shareholders any kind of a thing, obviously we will pay them the last. That is the reason, remember, whenever it is related to the shareholders, it is always after tax. A profit should be always after tax. Now a return on equity, he said. Now very specifically he said equity. Equity means what? They are the last payment receivers. So it will be again profit after tax. The extra point will be added is if any preference shares are there and the dividend is there, minus the dividend, preference dividend, net profit after tax minus from the get again preference dividend, we are going to minus it, and divided by equity share capital, that to paid up. Like for example, 1,000 shares are there, 100 each, but paid up is 80. So we will take a paid up value. So 1,000 into 80 means 80,000 we are going to take, not a 1 lakh. Understand? That is called a paid up. The next we have earning per share. So earning per share, again it is earning per share means usually it is related to the equity ma. So that is the reason wherever you find a equity, a profit after tax is a must. But extra you will minus what? Preference dividend. Whenever it is only very specifically we are calculating on equity, it is profit after tax minus if any dividend is there, we will minus that also. Divided by number of equity shares. Keep in mind number of equity shares. And the next one is PIE ratio, we call it. That is nothing but price earning ratio. So he will only provide you market value. So market value divided by EPS you are going to find out. Sometimes he will give you this value and he'll ask you to find out market value. So what you'll do, you just go for a cross multiplication. And the next one is return on capital. So return means again he is talking about a profits only, no? So here we will be taking as adjusted profits divided by. So here I am talking about any kind. Capital employed means I will have long term debt also. So long term debt means I can take before profit, means profit before taxes divided by capital employed. Capital employed is nothing but shareholders equity plus preference plus long term debt plus reserves and surplus all together. We have two formulas for capital employed: total assets minus current liability, or else shareholders equity plus preference plus long term plus reserves and surplus all together. So I am talking whenever I have a long term, so it can be a profit before tax. And if he is giving a return on assets, a return means assets means obviously again it will be after tax only. So PAT divided by total assets. If he is asking return on only fixed assets, then you will take PAT divided by fixed assets.